sound of a single, sharp electronic tone that quickly fades under the narration. Look at the tape. The behemoths of big tech, the Nasdaq proxy, QQQ, slipped 0.19%. Meanwhile, the broader SPY managed a microscopic tick-up of 0.18%, clinging to neutral. But the real story in the domestic indices isn't the lack of movement in the majors, it's the rebellion brewing underneath. The small cap barometer, the IWM, surged over a full point, plus 1.06%. This divergence tells us the narrative isn't about the behemoths leading the charge today. It suggests capital is rotating, maybe sniffing out value, or perhaps just taking a breather from the mega-cap AI obsession. Meanwhile, the fear gauge, the VIX, ticked up plus 4.20% to 15.12. This isn't panic territory, but it's the sound of volatility clearing its throat. When the tape is flat, but the VIX is climbing, it means traders are paying more for insurance. They smell uncertainty, even if the daily numbers look benign. And speaking of uncertainty, look at the currency desks. The EURUSD is weakening, down 0.5% to 1.17. That suggests a stronger dollar, or at the very least, continued apprehension about the Eurozone's immediate path. The backdrop to this cautious market dance is a symphony of geopolitical and central bank noise. Let's sift through the chatter from the titans who move markets with a tweet or a comma in a press release. On the political front, the tremors started internationally. We see developments in Venezuela, reports of Trump threatening the new leader, while simultaneously, Elon Musk's Starlink swoops in to offer free internet following airstrikes and the arrest of Maduro. This is high-stakes geopolitics colliding with corporate infrastructure. When national stability is questioned, capital flees uncertainty, yet here, a private entity is stepping in to provide a basic utility, complicating the narrative for sovereign risk. Then there's the US domestic political economy. We hear whispers that Trump's proposed tariffs are being forecast to create a grim US economy by 2026. Tariffs are taxes, and taxes slow down the velocity of money. This filters straight into corporate guidance. Speaking of guidance, the CEOs are busy. Jensen Huang of Nvidia is gearing up for a major presentation, a reminder that the AI sermon continues, even if today's stock price action was mixed. But the succession story at Berkshire Hathaway is front and center, Greg Abel taking the CEO reins from Warren Buffett. This isn't about immediate performance, it's about the long-term DNA transfer. Buffett's empire is built on patience. Abel must now navigate a world demanding instant gratification and exponential tech growth. On the hedge fund front, Michael Burry, the man who saw the 2008 housing crisis coming, is placing multi-million-dollar bets on gold. When a contrarian like Burry bets on tangible assets, it's a direct statement against the perceived stability of paper assets or the current technological narrative. Contrast this with Jamie Dimon, whose bank is reportedly thriving, a $770 million windfall suggesting the large institutions are indeed mastering the currents, or perhaps benefiting from market inefficiencies that others miss. Finally, the Fed chairman, Jerome Powell, is reportedly insisting he won't resign. This is less about his future and more about reinforcing perceived stability at the epicenter of global finance. Stability is the currency Powell trades in, even if the data coming out suggests otherwise. The bond market is where the true anxiety is being priced, because it's the market that directly measures the cost of money and perceived risk. Today, we see Ray Dalio pointing out a fundamental imbalance. The world is supposedly running out of appetite for US debt, yet America cannot curb its spending. That's a recipe for either inflation, higher yields, or both. And that brings us directly to the fresh inflation data. US CPI rose to 2.9% in August. That's hotter than expected, ticking higher. This inflation number is the primary antagonist in today's market play. It argues against immediate rate cuts. Yet, the market seems to have already priced in a very specific future. We have headlines suggesting the Federal Reserve isn't expected to cut rates until 2026. This creates a massive temporal gap. We are living with 2.9% inflation now, but the market is looking 2 years down the road for relief. That disconnect is where the tension lives. If inflation stays sticky above target, the yield curve should scream louder. But for now, the bond desks seem resigned to a long holding pattern, waiting for the Fed's actual pivot, not the rumored one. The global central banking cohort is certainly not on the same page, which fragments capital flows. In Europe, the ECB is getting speculative, according to the Financial Times, driven by commentary from Christine Lagarde. Speculative central banking means they are perhaps trying to balance immediate growth needs against persistent price pressures. And in the UK, the narrative around the GBP, USD is all about 2026 outlooks. Again, the focus is far on the horizon. This future gazing suggests the immediate path for monetary policy, the next 12 months, is seen as highly constrained, likely dominated by inflation fighting or economic triage. The overall theme is global divergence under the shadow of sticky inflation. The ECB is speculating, the Fed is anchored to a long timeline, and in the US, jobs reports are delayed by a shutdown, meaning our real-time view of labor market health is temporarily obscured. When data goes dark, markets rely more on headlines and sentiment, which explains the VIX twitching higher. Commodities are the traditional hedge against inflation and geopolitical chaos, and today they are sending mixed signals. We see a significant spike in Bitcoin, plus 1.84%, and Ethereum, plus 1.22%. This is crucial. When inflation ticks up, but tech stocks are choppy, digital assets are reasserting their role as a potential inflation hedge or, more accurately, a risk-on asset that thrives on liquidity perceived as being diverted from traditional equities. They are outperforming the S&P. Crucially, look at the headlines. Michael Burry is betting on gold. Gold, the classic safe haven. Bitcoin and gold are both rallying in concert. This isn't just about a risk-on trade. It's about a risk-off consensus regarding fiat currency stability in the face of persistent CPI. The dollar, however, is showing strength against the euro, EURUSD minus 0.56%. This is the counter-narrative. A strong dollar usually pressures commodities priced in USD, but the metal and crypto rallies defy that typical inverse relationship, suggesting the demand for alternatives is simply overwhelming the dollar's inherent strength derived from higher relative US rates. Now, let's zoom in on where the money is actually flowing within the equity markets. This is where the story gets granular. The overall market movement masks a fundamental sorting. The giants, Microsoft, minus 2.21%, Amazon, minus 1.87%, Apple, minus 0.31%, are all down, with MSFT taking a significant hit. The narrative that AI justifies any valuation seems to be facing its quarterly reality check. NVDA, the poster child for the AI revolution, is up a healthy plus 1.26%. This suggests that while the mega-cap tech stocks might be facing profit-taking or rotation, the core semiconductor infrastructure providers still command premium pricing. Investors are separating the AI infrastructure providers from the AI adopters. Contrast this with the laggards. Tesla is down sharply, minus 2.59%. This comes alongside a headline that BYD has overtaken Tesla as the world's largest BEV producer. This isn't just a stock movement. It's a perceived shift in industrial leadership. In an economy where growth is expensive and money is dear, the market punishes the most aggressive growth stories when their lead starts to erode. The clear winner today, structurally, is the small cap space, the IWM at plus 1.06%. This rotation out of the overbought Nasdaq giants and into the cyclically sensitive small caps suggests investors are anticipating either a soft landing or a market where value, not just future growth projection, dictates price. The crypto asset class is exhibiting distinct strength today, fueled by both macro uncertainty and narrative alignment. Bitcoin at $93,097 and Ethereum comfortably above $3,100 are showing resilience. This is the asset class responding directly to two specific data points: the higher-than-expected US CPI, and the persistent political instability in Venezuela, where Musk's Starlink is now a critical lifeline. In a world where global supply chains and national governance are becoming less reliable, decentralized, immutable digital assets look increasingly attractive. We are seeing a subtle, yet important, acceptance of crypto as an alternative settlement layer, especially when traditional institutions, like banks referenced by Jamie Dimon's windfall, are doing well, yet fiat purchasing power, evidenced by 2.9% CPI, is demonstrably shrinking. Michael Saylor, the crypto evangelist, is framing the debate in terms of color, orange or green. This captures the binary choice investors feel they face: stick with the traditional system, green, or embrace the digital revolution, orange. Today, the orange seems slightly preferred by those seeking uncorrelated returns. Looking forward, the market is in a waiting game, trying to digest the inflation number without definitive guidance from the Fed or a clear jobs report. The biggest risk tomorrow is the lack of clarity on employment. When the jobs report is delayed, sentiment becomes the main driver. If investors see the small cap rally continue, IWM, it signals optimism that the economy can handle higher for longer rates. If the Nasdaq giants remain under pressure, it suggests premium valuations are still being aggressively trimmed. We also need to watch for spillover from the geopolitical sphere. Any escalation following the events in Venezuela, or any definitive statement from Lagarde on ECB strategy, will immediately impact the EURUSD and the dollar's relative strength. The prevailing sentiment, captured by Cathie Wood's recent performance review, suggests that high growth, disruptive bets require patience. But patience is being tested when inflation is 2.9% and interest rate relief is 2 years away. What we are witnessing is not a unified market. It's a fragmented landscape reflecting deep uncertainty about the path of monetary policy versus the velocity of technology disruption. The tape is telling us, stop buying everything simply because it's an AI stock. Start asking, is this company essential infrastructure, NVDA, or just riding the wave, TSLA? The macro picture is clear. Inflation is sticking, CPI 2.9%, forcing the Fed's hand toward a distant rate cut, 2026, which means higher capital costs persist. This explains the rotation out of highly leveraged growth stories and into the relative safety of small cap value, IWM plus 1.06%. The final dot to connect is between Burry's gold bet and the crypto surge. When respected contrarians hedge against the system by buying ancient wealth, gold, and technological wealth, Bitcoin, it's a loud signal that the perceived stability of the current financial apparatus is being questioned, regardless of how well Jamie Dimon's bank is doing today. Sound of a single, sharp electronic tone returns, holds briefly, and cuts out.